Okay, it looks like we've already got 30, 40 people joined. We're expecting a few more, but we may as well get going. We've got a lot to cover in the next hour. So welcome everybody to the first webinar in our series, Raising Capital with the Offering Memorandum Exemption with Oziel Law and DealMaker. So we have a lot to cover today, as I mentioned. I mean, the Offering Memorandum is really one of the most exciting developments in the Canadian capital markets in recent years, allowing really any company to market their raise broadly to all potential investors, both accredited and retail, and an exemption that is starting to be used with a lot or much greater frequency. Today, we're going to cover off the core elements of the OM exemption, what it is, how it can be used, how it compares to other exemptions, some of the challenges presented by the OM and how it can be executed successfully. Given that the Regulation A+ is a big topic right now across capital markets in North America, we'll frame a lot of it with our experience, with our experience with the Regulation A+. As I mentioned, we've got a lot of material prepared. We only have an hour. We're going to try to leave 15 minutes open at the end for question and answer. But if you do have questions, please feel free to ask them. We'll also be sending a copy of our slides following the webinar to all the attendees, and we'll be happy to answer questions individually from anyone. So to start, we'll introduce the panel. I can start. So I'm Mike Werry. I'm the VP of Sales here at DealMaker, responsible for all our sales, but I spend a significant portion of my time focusing on the marketed general solicitation raises, like the Regulation A+ and the Offering Memorandum. I come to DealMaker with about 15 years experience leading sales teams and in both technology and capital markets, financial services. And I will pass it over to Rebecca Kacaba.
Thanks, Mike. So excited to be here with you guys today. My background is capital markets attorney, worked with a lot of people here I know on this call for over 10 years, taking companies public and doing private placements. And together with my co-founder, Matt, we saw an opportunity in the markets to streamline the capital raising process a number of years ago, and hence DealMaker was born.
Perfect. And Andy?
Great. Thank you, DealMaker, for inviting me here to be here today to speak to everybody. I'm Andy Andrei, and I'm from Oziel Law, a corporate and securities boutique in Toronto. Our lawyers work with startups all the way from the corporate formation stage to the going public stage. What makes us a bit more unique in this space is that we regularly use tech solutions and partner with technology companies like DealMaker to create efficient workflow processes and provide modern legal solutions. I myself practice mainly in corporate finance, and I generally advise both private and public companies on capital raises.
Perfect. All right, so we'll jump right into it. So, I mean, I guess to start this, let's move it over to Andy. You know, we know that the majority of the capital raising in Canada is done via accredited investors. I'm sure everybody on this call has a pretty good handle on those exemptions. But we've seen a significant increase in the amount of retail investors who are taking part in these raises. And what does the data suggest that we see here on how the OM has been used in Canada thus far?
Yeah, so just to kind of give out a lay of the land, we know that startups have found it typically quite challenging to raise capital in Canada. And have typically relied on VC and angel funding to get their initial operations going. Last year, a federal report, however, identified that there is a gap in the market, particularly between the 2 million to 5 million stage, where companies are consistently looking for capital growth in that range, but there's no capital supply. So one alternative is, we all know, to go public, but this is a expensive and time-consuming endeavor. So the regulators came out with the Offering Memorandum Exemption as an alternative to that more expensive process. And as we can see, since its introduction in 2016, at least in Ontario, the OM has been increasingly used over the years more and more and more. Despite this, the OM thus far has not been used in the way that it was designed to be used. which was by startup companies, mostly for simple raises in smaller amounts. In Canada, the use so far has been primarily by real estate companies and companies in the financial services sector, especially in Ontario. While in the Western provinces, it's been mainly mining and oil and gas companies that have used it as well. And they've used it to do larger, more complex raises. In 2019 in Ontario, there was $200 million that was raised under the Offering Memorandum Exemption, making it one of the largest private market exemptions after the accredited investor. And then in British Columbia, we saw 800 million being raised in the same year, and that might be because in BC there's no limits on investors, which we'll talk about later. In the provinces where there are limits on the amounts that investors can invest under an OM, we see that the largest number of people investing are those retail investors that can invest up to $10,000 a year, while the highest amount of capital comes from retail investors that are eligible to invest up to $30,000 a year.
Interesting. And Rebecca, given that, marketing to retail investors in the US is probably a few years ahead, primarily with the Regulation A+, what have we seen with the Reg A in the US and to sort of give us an understanding of where this may be going for Canada and the OM?
Yeah, for sure. So if I look at the US market, back of the envelope math, typically I think of it about 10x of the Canadian market. If you look at Regulation D in the US, you're looking at, over $300 billion raised under that exemption compared to 2.88 in Ontario. So significant use of Regulation D in the US, which includes a retail marketing component, because in Canada, you're talking about a credit investor being more closely held around. In the US, that exemption allows retail marketing as well. In the US, Regulation A is newer, but really picking up steam. It also allows you to more broadly go out to retail investors. And you're looking at 2.4 billion raised under that exemption recently. So OM is not too far off what's happening under Regulation A. What I think we're seeing in the US under Regulation A is a lot of retail investment, whereas in Canada, OM still being used for higher amounts by real estate and financial services. So as OM expands in Canada, maybe the amount raised won't go up as high, but we're going to see the number of deal volume significantly increasing as Canadian issuers taking advantage of Regulation A in the US say, hey, how can I extend this offering across North America? How can I get the most bang for my buck as I market to retail investors in the US? I want to extend that and do that in Canada as well.
Yeah, exactly. And I think, just in terms of some of the real opportunities and advantages of the Offering Memorandum, similar to what we're seeing in the US with the Regulation A+, are just the ability for any company to really use this as a structure to get their message out there and to broadly market. The interesting thing is accredited in Canada is really 1% to 3% of the total pool of potential investors. And this getting out there to, the remaining 97% gives a huge opportunity to issuers for raising capital, and especially, what that means. I mean, Rebecca, you can sort of carry on with anything else here that you see on from the Regulation A and how that feeds into the Offering Memorandum.
Yeah, so what we're seeing companies using Regulation A+ for is companies at any stage of their life cycle. Some of them are seed companies who might have a little bit of capital that they can invest into getting that round set up and the legal fees so they can go through the SEC review process. But we also have public companies raising, massive amounts, $50 million under a Regulation A+ retail raise. And how are they doing that? We'll touch on it later. They're marketing. A lot of them are consumer-facing brands that are marketing to their existing client base and offering them an opportunity to own part of the company whose products that they enjoy. And what that does is, as Mike said, it's a small pool of investors who are actually accredited. It allows them to go out to their customer base and say anyone can become an owner in this company now within the investment limit set by the regulators to make sure that it's safe.
Yeah, absolutely. And I think that, I'll touch on this a little bit more later, but we're seeing just a massive acceptance of these types of deals in the US, as well as starting in Canada. We've done a couple of deals recently within the last month that, it got out and to the right channels and the right forums, and we see massive adoption. Startups raising between 3 and 4 million almost within a 48-hour period because it got out there on the right channels, and the success has been massive, as well as a number of really big and successful Reg A's that with significant traction on retail, and companies that are would struggle to raise capital under traditional means, whether it's accredited investors or like a VC kind of route, being able to capitalize on the drive and the desire from the retail investor. And moving on this, I think that there are a number of elements that are also consistent on this slide, similar to the A+ and sort of other raises in terms of multiple and concurrent offerings. But there are elements here, private companies remaining private, and the limits on the time or amount of proceeds raised that are actually unique to the OM. And maybe Andy, you can give a bit more framing on what that means.
Yeah, so just to add to the multiple and concurrent offerings point, you can latch on under the OM other exemptions as well. So you can still increase the price that you're going to raise at, and you can also raise from accredited investors at the same time. This might streamline your raise because you're just using one document to give information to investors at the same time. So that can be a powerful tool. The multiple closings also gives you the ability to, let's say, close the offering earlier on your minimum, and then use the amount of proceeds that you raise to gain more traction in your business. And then you can just go back to the OM, update some additional disclosure, and raise more funds under that. For the companies remaining private, some companies just don't want to become public companies. And the offering memorandum, the benefit of that is that no matter how many shareholders you have or how much money you raise, you always remain private, subject to maybe some additional reporting requirements. In terms of the limit on the length of time, this is great because it gives companies the flexibility to structure the raise in accordance with their business model, need for capital, and ability to provide proper disclosure and transparency. So, for example, if your business requires a patent application in order to move forward to the next stage, you can wait until that's received before you close on the offering memorandum.
Exactly.
Yeah, and just to kind of finish on the no limits, that pretty much speaks for itself. And I'm sure a number of folks will say, well, you're probably limited by the number of investors that are in Canada. But we have seen some successful financings in substantially large amounts of capital that have been exclusive to the Canadian market. So we think there's potential.
Perfect. And I see that we've got a couple questions that have come in. I'll sort of open up one here, and I'll open it up either to Rebecca or Andre or Andy, because we have sort of covered the idea behind IPO versus offering memorandum, but it's that OM for a sophisticated entity is not necessarily significantly cheaper than an IPO, given the IPO benefits. But I think that overall, I would see it as probably a different kind of company that would benefit overall. But I don't know if you have thoughts on that you wanted to share, because it's an interesting question.
So I have a thought on that, which is today we're mostly considering the OM as an opportunity for startup and medium-sized companies that aren't looking to go public immediately. I mean, it's true that an OM does have disadvantages in comparison to going public. And Rebecca, I don't know if you have any additional thoughts to add to that.
I would say I think doing an OM offering is going to be significantly cheaper than going public, and we'll get into the cost structure that we've brought forward with launching the actual raise later on. But I think the ongoing disclosure is significantly less than being a public company and the infrastructure you need to run a public company. and the qualifications of the people you need, and the board lots. I mean, it's going to be significantly cheaper.
Yeah. Yeah. Awesome. And so I guess, you know, one of the big questions, or one of the biggest differences between the OM and the Reg A is that the OM doesn't have a need for qualification from regulators, and therefore, you know, is theoretically quicker and, you know, potentially less cumbersome to get going. Andy, I'll sort of put this over to you as our securities expert here. You know, what do we need to do to create the OM exemption form, and can you take us through that?
So the OM document itself is kind of like a detailed business plan that highlights information about your business and enables the investor to make an informed decision on whether to invest and what risks are involved with that investment. The interesting thing about the offering memorandum form is that it's a mixture of a legal document and also a marketing document. So as a legal document, you're on the hook for misrepresentations, being false statements or omissions of information, which an investor should have reasonably known before going ahead with their investment. So you have to balance the promotional aspect of the disclosure while keeping in mind that it's still a flexible enough document that you can use to market your company. Now, just because it's a legal document, that doesn't mean it has to be boring. You can get some creatives on board and incorporate infographics and visualizations to capture the attention of investors. In terms of different elements of the OM form itself, a significant component of it will be displaying that the company has a solid management team. So the OM form requires detailed explanation of the team and their experience, which should weave into the narrative of how management will advance the company's business objectives. And think of this as an opportunity to establish professionalism and credibility with your prospective investors. You have to disclose if there were any prior bankruptcies, and under proposed new rules, you'll also have to disclose quasi-criminal offenses. So keep in mind, your management team is and will be a reflection of your company. And in terms of some other elements, the terms of the offering itself is something you'll have to disclose. Investors will look at how you propose to use the proceeds from the offering and whether or not you have a reasonable valuation. You ideally should demonstrate value through your financial statements and disclosures, and the intended use of proceeds should result in the business plan moving ahead and hopefully creating increased value for your shareholders. Because you're marketing to the general public, the retail investors, you are required to have audited financial statements for that year. The auditing firm itself has to be independent, so they can't be your internal CFO or your accountant that's been doing your current record keeping. How long the audit typically takes depends on the duration and complexity of your business operations and how well you maintained your corporate and financial records. If you're thinking of using a smaller accounting firm, you should consult with your lawyer and make sure the firm has the registration requirements under Canadian securities law.
And I think there, you know, with the audited financials, that's something that, you know, can't be necessarily automated too much. But with the three other components, you know, you can use technology to automate that. Rebecca, I wanted you to jump in and sort of talk about the document generation software that we've created to support that.
Yeah, so I think one of the big costs, going back to the question on cost, one of the big costs has always been preparing this disclosure document, lack of familiarity with the form, a lot of back and forth between counsel and the issuer, and using, you know, getting our professionalism hours here, using technology in 2021, we're in a new era where that doesn't need to be the case. And we've really seen this in the US market. A 1A is an incredibly complex, lengthy disclosure document. And the US firms have brought down the cost of those documents tremendously and are doing flat fee all-in packages in something that is in complexity between an OM and a prospectus offering. And in the time that I was practicing, you know, we saw the cost of doing an IPO short form prospectus come down to a third of what it was when I first started. So I want you guys to think about the OM exemption in the same fashion. The exemptions there, it hasn't been tremendously taken advantage of, but with technology powering it, there's now a different opportunity than there once was to take advantage of this and to bring down the level of complexity into something that investors can understand and issuers can understand.
Yeah, and it's especially for, startups, smaller businesses, medium-sized businesses who don't have a ton of experience and apparatus in terms of dealing with this. It's a huge benefit for them.
Yeah.
So, I think on this slide, everybody is probably, or the majority of people on this call are familiar with the top three exemptions. They're a significant portion of the capital raised in Canada every year. But Andy, you can jump in a little bit and sort of explain some of the differences between the CF and the OM and some of the drawbacks of the CF overall.
Yeah, so the startup crowdfunding exemption allows startups to raise relatively small amounts of capital by using a designated online platform called Funding Portal. They use this to post a crowdfunding disclosure document similar to the Offering Memorandum form, but a little bit shorter. And that's what's used to sell securities and raise money. Like the Offering Memorandum, the startup crowdfunding exemption allows you to raise funds from the retail public. But under the exemption itself, the marketing is much more restricted because you're limited to posting on the funding portal. In terms of advantages, the crowdfunding exemption doesn't require audited financial statements. So that can make it a cheaper fundraising option, especially if your company has more complex business operations. The crowdfunding disclosure document itself, as I mentioned earlier, is shorter, requires less information, so that's potentially a cost savings. And there's fewer post-closing and compliance requirements. So, those are kind of the advantages that the startup crowdfunding exemption has, but there's also, overall, it's much less flexible than the OM. You have a time limit on the distribution period, which is limited to 90 days and only twice a year. If you fail to meet the minimum amount of funds that you said you were going to raise within that period, you have to return the funds that you did raise to investors. There's also a limit on the amount investors themselves can invest, as well as a limit annually on how much you can invest relying on this exemption. You're forced to use the funding portal, whereas with the OM, you can do the advertising and marketing on your own. And you're also not allowed to pay any finder's fee. Lastly, I would say an important consideration for those in the US is that this exemption is only available to private companies and investors resident in Canada.
Yeah, and that's also an interesting point in terms of using a funding portal for the CF. And one of the things that we see as a big benefit for Reg A and for most companies is the ability to really control your brand and to be able to have complete control over how that's marketed. And you're not sitting next to another company or whether it's a competitor or something completely different. You're able to sell your story and engage investors in the way that you want with total control.
Yeah. For example, like we had one, medical devices company that says, okay, we think this is a great product that's going to be well understood by the medical community. And so what are the resources, newsletters, different association groups that we can go out and market ourselves to gain interest and investment from that particular type of community? There's a whole different world out there you can do using the internet to make different groups aware of your company these days.
Yeah, and I think that's a big piece of what we also see with our experience with Reg A or even 506C in the US, just because we've done so many of those deals, is that with some of the funding portals that are used, oftentimes the issuer ends up spending a significant sum of money to support that and to drive people to it. The promises of driving investors to your raise are not necessarily met. is the experience that we've seen. And so just being able to control it from the outset, ensuring that your brand and your company is displayed exactly the way you want to, and not beside a company that you don't want to be associated with on a portal is really important. And we're seeing a lot of success from that, and the ability to really market to the investors that you think are your core segment. And it allows people to raise money faster and generally cheaper without having to add in a portal.
Yeah. So one of the questions that we're getting a lot these days is Canadian issuer conducting a Regulation A+, and how can I extend my marketing across North America? And so when you look at how they can do that, sure, they can do an accredited investor wrapper, but they can also do an OM wrapper and get the benefit of more of their marketing spend. So we're seeing these exemptions used by both public and private companies. As Andy mentioned earlier, the benefit on OM is that an issuer can use it for a smaller startup round, but they can also use it for significantly more capital. The way we're seeing a lot of our issuers on Regulation A hit what was recently their 50 million max, some of them hitting that within 3 to 4 months when they get the formula right. Yeah, Andy, anything you want to say about the accreditation or the prohibited securities limit?
In terms of figuring out which investors can and can't participate in the offering, the Canadian exemption makes it a little bit easier because it gives you a bright line net assets and net income test. And if you meet those requirements, then you can invest. Whereas in the US, it's percentage based, so you have to find out more information about the investor on an individual level. And DealMaker will talk about the solutions that they've offered in terms of streamlining, figuring out who can and can't invest under the OM.
Yeah. Like that's one of the things that's traditionally made it very difficult to do an OM is, knowing what province the person is from, knowing whether they meet the eligibility requirements versus the accredited investor requirements, and then what's the limit on the amount they can raise. Using software which can auto read their address and parse them into a question flow that tells them their limits based on their background, you've now made that validation process significantly easier. As well, using integrated background checks at the click of a button, you can be doing Bank Secrecy Act or any FINTRAC type compliance also at the click of a button. So those kinds of things that weren't possible without technology are now possible, and thus the exemption, we need to take a second look at it and realize that it's a lot easier of a process to manage today than it was even a year or two ago.
Absolutely, and we'll cover that in a lot of detail in a couple of slides. But that's exactly it: is being able to use technology to enable it. I think there's sort of a couple different things in terms of just comparing the OM to the Reg A. The big difference is the being able to sell without qualification from regulators. That's a huge piece of the puzzle that, it's on the Regulation A+, it means about a 90-day window between your filing and your qualification. With the OM, that reduces your cost, it reduces the back and forth, any subsequent documents, especially if you're using the doc generator and have audited financials prepared. But it takes it down to, really it's the issuers and their team's ability to get the form generated, and that can be done in the span of a week. We would probably say 4 to 6 weeks is probably the right time to get everything together, but it can be done quicker, and there's not that there's not that test that you need to go through. Andy, I'll sort of ask you to talk a little bit about 12G, but with the OM, private company can always remain private, which is a big thing, and it's a concern that we've seen from a couple of Reg A issuers recently about the 12G requirements.
So without getting too technical into the rules, in the US, if you've raised over a certain threshold of funds, or if you have like a certain, past a certain threshold of investors, you're deemed to be registered under this 12G section. There's an exemption to it, which you can potentially meet. But what that effectively does is it subjects you to more disclosure requirements, more onerous than those in Canada, which we don't have. So yeah, that's a big benefit of the OM.
Yeah, and what are the ongoing reporting? Oh, a little bit of feedback there. Sorry, what are the ongoing reporting requirements? And I know they vary by province after completing the OM.
Yeah, so in British Columbia, for example, you have the audited financial statements in the OM, and you file those that you provide a year later, and then that's it. Whereas in Ontario and those provinces, you have ongoing obligations after you use the OM exemption to provide audited financials every year, as well as a notice of use of proceeds and notice which talks about how you use the proceeds versus how you said you were going to use it in the OM form. So regulators want to make sure that companies aren't just raising money and then going off and doing whatever they want with it. And another requirement is to specify if there was like a key event that occurred, something like a bankruptcy or a change of control. Think of it as a material change.
Yeah, and here this is also a slide for Andy. Overall, just like take us through the jurisdictional OM investor limits and sort of how it varies by the three different regimes across Canada.
Yeah, so the Eastern, Northern, Western was just my way of classifying it for ease of reference. That's not actually how the regulators call it. But because the regime in Canada is so fragmented, I thought to classify it by the provincial powerhouse of the regulators. So in the Eastern regime, you have four, I would say, stratifications of the kind of investor that you are in. Depending on that, the regulators limit how much money you can put into an OM offering. So any retail investor, it can invest in both Northern and Eastern up to $10,000 a year under the Offering Memorandum exemption, and that includes any other OMs that they participated in. So not just your company, but any other company. Then in Ontario or in the Eastern regime, you have investors, I would say like upper middle class investors that make $75,000 in the last 2 years each year, or who have net assets of $400,000. And this could include with your spouse, and it could include your personal residence, provided that you subtract any mortgage payments. They can invest up to $30,000. So you're looking at quite a significant amount of people in major cities, at least in the Eastern regime, that can participate in that bucket. If you get suitability advice from a portfolio manager or a dealer, then those individuals that are eligible can invest up to $100,000 a year. If you're also distributing it to accredited and friends and family investors under anywhere in Canada, that's unlimited, as we discussed previously. In terms of the Northern regime, you have the $10,000 limit, and then you have if the investor receives suitability advice, they can invest an unlimited amount as well. So,
yeah.
And interestingly, in British Columbia and the Western regime, there's no limits at all. So.
Awesome. Yeah, and I think that's the ability to capture all potential investors. We've seen that across the board with a lot of our market raise. I mean, whether it's OM, whether it's Reg A, where they're able to raise their goal, whether it be 3 million, 10 million, 50 million, and they're doing it with a combination of retail, accredited, and institutional. It doesn't limit the ability to accept investors from other classes. What it does is it really opens it up across the board, and I think that's probably the biggest and most meaningful thing that for a lot of issuers out there is being able to capture absolutely everything. And this sort of will go into now we'll talk a lot about the technology specifically. And this sort of goes into one of the questions that I saw earlier with respect to just the cost differences. And really, because of those three different regimes and the reporting, the requirements across them in terms of understanding what jurisdiction they come from, where they fit in terms of, eligible, non-eligible, accredited, friends and family, et cetera, it's a bit of a nightmare. And that has been a costly thing to manage. And that's why you see, Andy talked about this on the first slide, why you see a lot of, BC raises that are very BC specific, or Ontario raises, particularly for real estate, that are very Ontario specific, because they're able to market and do those raises, but it's not been cross country. And that's really what is needed to be able to manage a proper OM raise in a broadly marketed fashion, and accept investors in across the board to truly make it something appealing. And I think the combination of DealMaker and the OM in terms of our ability to process investors according to jurisdiction and eligibility is really special. And I'll let Rebecca sort of frame a bit more about the DealMaker side of things and technology.
Yeah. Thanks, Mike. So I think if you look at the deficiency rate on subs that the legal community pegs it at, it's about 70% if it's offline, right? And so when you bring those subs online and you start using technology and you can parse people into the correct exemptions, they're going to get a notification that says, okay, based on the address you gave us, based on the questions that you answered, you can only invest $10,000. And so when they go to now enter their payment and process their payment, they know how much they can actually invest. And so you bring that deficiency rate down, counsel is going to continue to check over the subs as they come in, but you're able to actually conduct that offering in a compliant way with a lower deficiency rate that makes it actually feasible. Because if the error rate on subs is 70% and then you put a complex OM sub in front of non-accredited investors, you're going to get an error rate on paper at least 85%. I mean, that's not really a manageable offering to be having 85% of investors re-sign their agreements. So when you implement the software, you can bring that down to 1 or 2%. Suddenly you've got an opportunity to conduct that raise.
Yeah. And that's the real, we'll get into the overall cost, but it's probably not too unreasonable to suggest that earlier question in terms of, for a company prior to what we're trying to do here with the OM and the use of the DealMaker software to manage this, that it would have been, a considerable cost, maybe akin to an IPO. I'm not 100% on what that would cost, but this allows you to do it for, whether it's between, let's call it 1.5% and 3% of the total amount raised, which is an entirely reasonable amount. We can dive into the cost a little bit more. Andy, if you have any additional comments there on some of the legal challenges. I know Rebecca covered a lot, but and from my standpoint, just having the need to have a review on every single one of those documents is incredibly challenging, but I'll let you weigh in there.
Yeah, so the legal challenges I think you mentioned before really have to do with making sure that there's no misrepresentations in any of your communications to investors, and that you're filling out the form properly, the offering memorandum form. And it's not enough just to copy and paste from other companies in your industry and think you'll be okay. The disclosure really has to be tailored to your business, and each business has its own unique challenges and risks. So, in the past, companies would rely on lawyers a lot to put this together for them, and there would be quite a number of back and forth because one knows the business and the other one doesn't. But what we've worked on is developing a form which mirrors the offering, all the elements of the offering memorandum. That's a question and answer based form that gets you to about 80% of the document. And then we take it over from there and review the disclosure and make sure that it's compliant with all the rules and that it makes sense. So we're really trying to narrow down that time and that back and forth while still capturing all the accurate information about the company's business.
Yeah, and I just want to reiterate that because I love what Oziel has done there, right? Like they've taken all that process time out and they've focused on what really matters, which is understanding the client's business, making sure they don't make a misrepresentation. And so it's kind of like a reallocation of how they use their time by leveraging the technology.
Yeah,
Exactly.
100%. And I think that sort of leads us well into this next slide over here. And I'll take it through, but I think, what we've done is between, DealMaker and Oziel is try to create a really out of the box and efficient and inexpensive solution for running the offering memorandum and running it successfully. And there's sort of 4 different parts of that, just to sort of give a bit of a pitch for the next webinar. The next webinar will be really focused on marketing and how to market successfully and our learnings there in terms of what that recipe is. So we're looking forward to that and look out for further communication. But the document generation software to create the filing, that's an invaluable tool to be able to both expedite and do it in an easy way with just basically answering the questions that you're going to need to answer to create the form, plus the audited financials. Oziel, Andy, I'll let you add in on anything there that I might leave out, but really just experts in the OM, managing through all the documentation, ensuring that it's complete and compliant, the structuring of the raise, obviously hugely important. And then the post-closing obligations and regulatory filings, that's that streamlining that process and making sure that it's a ready-made package for you and unique to your business, but a ready-made package is incredibly important as well. Anything to add in there, Andy?
No, I think you've covered it off. I think the only thing to keep in mind is that after closing your OM, you have a 2 business day period where investors have withdrawal rights if they change their mind. It's the cooling off period. So we also have a trust account where you can keep your funds deposited in trust, but a lot of companies also choose to use escrow providers or other service providers for that. Just to move on and add about DealMaker. So we actually, even before we partnered on this, we worked with DealMaker and we encourage clients to use DealMaker and just say that it's a very easy to use platform. It's very intuitive and it really streamlines the entire subscription process. I've also worked on deals at bigger firms where we've had to manage all the paper documentation coming in and out, and DealMaker just really made a huge difference when it came to that. And when you're looking at something like an OM offering, you're looking at volume. So to manage all these different subscription agreements coming in from different jurisdictions would be a nightmare. And I really don't think that we'd be able to do an OM offering deal without DealMaker, frankly.
Well, thank you for that. And I think, what DealMaker adds in is, there's a number of things, but, as we touched on the previous slide, it's the ability, it's a clean, engaging and simplified process for the investor. When you're dealing with retail investors, it has to be as simple and as clean and compelling for them as possible. So boiling down the sub agreement to a series of based off of the jurisdiction and their answers to the previous questions based on their eligibility or accredited status, to take them through a question flow that just asks them to fill in the blanks or select the right answer. So the sub-agreement is filled out correctly every single time, as well as manage payments. That's one of the really cool things about, that we've seen with Reg A and the marketed raises in general, is the ability to, accept investment through things like credit card, which, does a couple of things. It does increase conversion. It makes it easier to invest, and it generally means more investors will come in because they don't have to go through the process of going to their bank to send a wire or, mailing a check, which, to be fair, can cause some drop off after signing for people who just don't go through that process. So it makes it really easy there. The insights and analytics, hugely important. We plug in with the marketing. It's a big difference for people with a lot of experience doing, more AI friends and family rounds with whether it's, 3, 5, 50 different investors. It's a whole different ballgame when you're talking about 500, 1,000, 5,000 investors coming in, and being able to understand really specifically, where investors are coming in, what marketing efforts they're coming in from, and being able to see that in real time, to see conversion as well as average investment rates to manage your spend is really important. And then the DealMaker CRM, which gives you the ability to actually, see in real time where every single one of your investors is, so that, investor relations and different teams can follow up. You can engage with them and drive them through the funnel to increase conversion and really manage your raise, much faster than was previously possible, both in terms of time to launch and time to close. And also, we have the apparatus to take your investors and also provide the post-closing document delivery, which is, just something to streamline. And then the final piece is the marketing. And, between DealMaker and Oziel, we can connect you with our team. We have a group that ensures you are taken, or our customer success team will take you through and make sure that the raise is properly set up. You're introduced to the right partners and have a plan to go out to marketing. But they're responsible for creating the materials, branding, messaging, and driving the digital acquisition of investors. Particularly retail, but also for expanding your reach to different AI or accredited investors. Anything to add in there?
I want to touch on the point you made about, getting up into the numbers of 500 to 1,000 investors. Like, we've seen US companies publicly traded conduct a Regulation A offering with a lot of success with those numbers. It may be used by a public company who wants to increase their retail investment and impact their trading price. The sort of philosophy behind Reg A marketing is consumer-facing brands, inviting people who are loyal to the company and going to be good investors into trading the stock. And I think that same philosophy can apply for a Canadian public company.
Absolutely. And I'll just say that we are at the 10-minute mark. We've actually managed to do, I think, an unbelievable job of getting through the material. So thank you to you both. But, as we're sort of going through the final slides, I would just say that if there are questions out there from the audience or anything that you want us to cover that we haven't or provide more clarity on, please feel free to use the chat window to give us questions, and we'll be happy to answer them. So in terms of the process, we've covered a significant portion of the process thus far. I'll open this up to, maybe Andy to talk about, step 1 and step 2, and then, Rebecca and I can sort of cover off 3 through 5.
Yeah, so an important first step and what generally reduces the cost of overall for an OM offering is to organize yourself and identify your business needs right at the outset, so that when you're coming to your service providers, you can basically give them the information which they'll request. And this would be like making a business plan, documenting any informal arrangements that you might have with your management, for example, and organizing your internal corporate records, your minute books, your company's capitalization. If you come in prepared and have all of that ready, then you can get going right away. Otherwise, you should just consider that those things have to be taken care of before you can launch on the process. And just to emphasize how, when you want to structure your OM offering and things you want to consider, it's important to hire and retain the professional service providers right from the outset. DealMaker and Oziel, we will help you manage the overall deal and keep you on track with all the different moving parts, coordinating with the auditors, marketing firms, transfer agents, or other financial professionals that you may need in order to do this. So I'll turn it over to you now, Mike.
Yeah, I think that I guess the drafting of the offering materials would also sort of fall under Oziel and counsel on that side. But I think, where we often step in a really meaningful way is the engaging of the marketing partner, introducing to our network of people who are really skilled in marketing to investors and digital acquisition of investors, and really building that strategy. And that comes into play with understanding the market segment that you're after. We've got a couple of different raises ongoing right now. One that's very education focused, and so understanding how to go after people who are involved in education, teachers groups, and other people in that area as a core means, or like the medical technology. We see a lot of raises where there is a very defined group of people who are interested in, and it's understanding how to reach them and how to engage them and what that segment is, because that means your ability to do that and work through that early on means a lot more success quickly, more money through the door quickly, and ultimately a faster raise. The OM has no time limit. And definitely no limit on the amount that you can raise, but all things being equal, it's better to raise the amount that you need in a month or 3 months versus 12 months or 18 months. And that's what really can be done by building and crafting a good strategy. Rebecca, I can let you sort of weigh in terms of what the process looks like, from sort of like onboarding to launch with DealMaker, and the process that we put people through overall to get them set up.
Yeah, I think that covers it generally. You get a customer success rep that's going to be with you through the life cycle of the deal. And so make sure the deal is set up for success, onboard the deal, go live, train people to use the software, and give you best tips and practices on how to close up the deal. I just want to respond to some of the questions that I saw come in. Maybe if you want to jump back to the stats slide, there was a question about how use of the AI exemption compares in Canada to OM. Like the vast majority of capital raised in Canada right now is under AI, right? But I think the opportunity we're highlighting here is based on what we're seeing in the US. Regulation A is quickly catching up to Reg D, based on what's happening in that market. Retail investing is hot during COVID, a lot of money coming in by retail investors into investments in general. And so there's an opportunity for Canadian companies to capture some of that capital and propel their businesses forward.
Yeah, and
absolutely.
Just to add to that, just even the way that you raise capital under the OM would be different under AI. It's generally cheaper to raise funds from your customers rather than from a VC or an angel investor. There's, you won't have to negotiate a board seat or potentially lose control over some of your company. So there's other elements to consider rather than just monetary value that can be important to companies as well.
Mm-hmm. And we had a question about some real life examples. I mean, to be fair, we've got 3 ongoing raises, so I can't give great detail or give full details on them. But I think that and we can talk even more about our experience with Reg A. But I would say for 2 of the ones that are just in the process of closing out their raise, it was both of them were startups. Relatively early stage with, both of them were sort of on trend or on with, just the overall capital markets, the combination of, whether it's, EV or gaming or different elements that are on trend for the overall capital markets. We've seen that be a big drive, but both of these companies were, expecting to raise somewhere in the range of 1.5, 1 to 1.5 as the sort of total goal. And, it was both of them within a matter of a week of going live on DealMaker were the link the invites to their investment were shared into different groups, into different forums, and on different channels. Both of them actually particularly driven by retail investor forums. And the story was appealing. And within both of them, within, let's call it 7 days, one was 48 hours really, they raised both of them over 4 million. One got to 5.5 and one got to 4.2. And so, huge success stories. It was overwhelming, I think, for the issuer to see, the issuers to see the success, dramatically overnight. But we've had a couple recently on the Reg A side too. One Canadian company, one US, that have had similar trajectories. In a month and a half, by getting out and to the right segments and the right groups, they were able to raise, whether their goal was $4 million or $20 million, able to raise that in a really meaningful way. With 3 minutes left, the final question that I see here is the minimum time in operation before launching an OM, i.e. if you don't have financials to audit.
I think there's going to be some setup costs. So you're just going to make sure there's a bit of seed capital in the company to get you set up and get, the OM drafted and legals and initial marketing costs. But in terms of stage of the company, could be right at inception. A lot of times, I know from raising capital, when you're selling an idea, that can be easier than when you've actually got revenue on the books and an operating business. So I don't think stage it doesn't matter stage particularly. The sort of conventional Reg A wisdom has been consumer retail facing brands, story that people can easily identify with and grab onto are going to be the most successful. But we've seen mining and oil and gas companies do successful Reg A's. So I don't think that necessarily holds true. The original Reg A story being like Brewdog's, a beer company, we've seen that happen a lot. With OM as well, successful alcohol companies where you've got clearly a loyal following who says, yeah, I'm going to drink this on the weekends and I'd love to be an owner in the company of the brand that I'm drinking. So that's a very easy retail story to tell, but it doesn't mean that other stories won't be successful. Where I think there's a really exciting opportunity is I've always seen less of those stories get funded in Canada because, the trends of the investment banking industry go in ebbs and flows. The VC community has a different story that they're backing. So I think there's a huge opportunity for Canadian entrepreneurs in these sectors to get their stories funded in a meaningful way that they couldn't without this exemption.
Awesome. I think that's probably the perfect point to leave it on. We're at 12:59. I just wanted to say thank you for everybody that's attended. Thank you very much to Rebecca and Andy for your expertise. I've had a lot of fun in doing this. So and I hope everybody else who is both watching and attending has had equal amounts of fun. Look out, we will be sending around information on our next webinar in about a month's time on the marketing side of things. If you have any questions, don't hesitate to reach out to any of us. We'd love to chat at length about any of these details. And yeah, thank you very much.
Thanks, everyone.
Thank you.
Bye.
Bye.